Good morning. Today we are initiating a deep dive into GitLab, ticker GTLB. We view this asset as a primary beneficiary of the secular trend toward vendor consolidation in the DevOps ecosystem. GitLab operates as a comprehensive DevSecOps platform, replacing fragmented toolchains with a single application. Our analysis suggests that despite macro headwinds impacting IT spend, GitLab's mission-critical nature provides defensive characteristics. Currently trading at a premium to the broader software index, but a discount to historical averages, the stock presents an interesting entry point for institutional capital looking for high beta exposure to the software delivery lifecycle. We will cover the financial model, valuation multiples, and the asymmetric risk-reward profile driven by their recent AI integration. Let's strip away the marketing layer and look at the fundamental product architecture. GitLab's core value proposition is the single application model. Unlike competitors that acquire and loosely integrate disparate tools, GitLab was built from a single code base. This creates a unified data model, significantly reducing friction for enterprise engineering teams. For a CIO, this translates to lower total cost of ownership, TCO, and reduced integration debt. This architecture forms a significant economic moat. Once an enterprise migrates their entire software development lifecycle, from planning to security testing onto GitLab, the switching costs become prohibitively high, resulting in the sticky retention metrics we will discuss later. We define the total addressable market for DevSecOps as roughly $40 billion today, expanding to over $80 billion by 2027. The market dynamic is shifting from best of breed, where companies bought the best individual tool for each task, to best of platform. Gartner predicts that by 2027, 75% of organizations will have switched from multiple point products to DevOps platforms. GitLab is effectively a duopoly player alongside Microsoft's GitHub in this space. While GitHub has the developer volume, GitLab often wins in complex enterprise environments, requiring stringent compliance and self-managed instances. This consolidation wave acts as a massive tailwind for GitLab's revenue capture. Turning to the top line, GitLab has historically demonstrated hypergrowth, with revenue growth rates previously exceeding 60%. As the law of large numbers sets in, we are seeing a deceleration to the 30% range, which is still best in class for public SaaS assets. The metric to watch here is annual recurring revenue, or ARR. Specifically, look at the growth in customers contributing over $100K in ARR. This cohort is growing faster than the overall base, indicating successful upmarket penetration. Despite macro pressure causing some seat compression, the enterprise segment remains resilient. We project a revenue CAGR of 25 to 28% over the next 3 fiscal years. In the SaaS valuation framework, net dollar retention, or NDR, is the pulse of the business. GitLab has historically boasted an elite NDR above 125%. This means that even if they acquired 0 new customers, their revenue would grow by 25% annually, simply through upsells and seat expansion within the existing base. Recently, this has compressed slightly due to IT budget scrutiny, moving closer to 115 to 120%. However, their pricing power remains intact. The migration from their premium tier to the higher margin Ultimate tier is a significant lever. The Ultimate tier adds advanced security features, driving average revenue per user, or ARPU, expansion. GitLab is in a transition phase from growth at all costs to efficient growth. Gross margins are stellar, hovering around 88 to 90%, typical of high-quality software. The concern has always been operating margin. We have seen a pivot. Management delivered their first non-GAAP operating profit quarters recently. They are effectively leveraging their R&D and sales and marketing spend. We model a steady march toward a long-term operating margin target of 20%. Free cash flow causativity is now a reality, which significantly de-risks the investment thesis in a high-interest rate environment where capital is expensive. How do we price this asset? Traditional PE ratios are not yet relevant given the early stage of profitability. We utilize enterprise value to sales, EV sales. GitLab typically trades at a premium multiple, often between 8x and 12x forward sales, compared to the sector median of 6x. This premium is warranted by their growth rate and duopoly status. However, we must be disciplined. An entry at 14x or higher assumes perfection in execution. We compare GTLB to peers like Datadog, Atlassian, and MongoDB. If the multiple compresses to 7x while growth sustains at 30%, the stock is undervalued. Conversely, growth deceleration below 25% would trigger significant multiple contraction. We cannot ignore the AI narrative. GitLab launched GitLab Duo, a suite of AI-assisted capabilities, including code suggestion and security remediation. This is an add-on monetization layer, priced at roughly $9 per user per month. This is critical for two reasons. First, it defends against GitHub Copilot. Second, it increases ARPU without increasing customer acquisition costs. Early institutional checks suggest strong interest, but we are waiting for concrete revenue attribution in the upcoming quarters. If Duo achieves even 10% penetration of the installed base, it represents a massive revenue unlock. A responsible analyst always looks at the downside. The bear case for GitLab centers on three pillars. 1. Macro-driven seat compression. If layoffs continue in the tech sector, GitLab's user count drops directly. 2. Commoditization by Microsoft. GitHub is bundling aggressively. If they price dump to win share, GitLab's margins could suffer. 3. Valuation overhang. Even at 9x sales, the stock is expensive relative to the cost of capital. A risk-off market environment punishes high-multiple stocks first. We are monitoring churn rates in the SMB segment specifically as a leading indicator of trouble. In conclusion, we maintain a constructive long-term view on GitLab. The consolidation of the DevOps toolchain is not a fad. It is an operational necessity for modern enterprises. GitLab is the only true independent alternative to Microsoft in this critical infrastructure layer. We project them to compound revenue at 25% plus, while rapidly expanding free cash flow margins. For the portfolio manager, we recommend an overweight position, but advise scaling in during volatility. This is a high beta asset that will outperform in a risk-on environment driven by AI adoption and enterprise digitization. We set our 12-month price target based on a 10x forward revenue multiple.